Good evening and welcome back. I'm sure you're pretty tired of me, but trust you me, this is one more, one more time you have to suffer. I have one more session to do. So this is a small finance bank. All of them are between 5 and 6 year old. Not this gentleman, they're babies, the small finance banks. And the question is, can they make it big? Uh, Hand on heart, I will ask them that how has been the 5 year or 6 year journey? Did you expect this way? Are you still a toddler, or a few of them actually have got up and started running? We'll see. It's a very interesting composition, you see. 5 of them, out of which this gentleman at the middle, Alok, is a professional. He is the CEO of MFIN, which is an organization, sort of SRO, what do you call it, for the microfinance entities. De facto, SFBs also, small finance banks are also into microfinance. So, Alok's, if I say surveillance is not the right word, but what is the right way of doing it? Alok's connectivity with them is there. And the 4 of them, they are all founder, you know. Samit is the founder, and but he's not the MD, no executive role for him. That's Ujjivan from Bangalore. Bhaskar Babu, founder, and as well as Suryodai, he is our homegrown New Bombay, Suryodai Bank. Bhaskar Babu is the founder and MD and CEO. Then you have Paul Thomas, again founder and MD and CEO. So all of them are entrepreneurs turned bankers having executive role. And Vasudevan, as we speak, he is the MD and CEO, but it's in public domain, and ESF is Equitas is a listed entity. You have expressed your desire to quit, right? When is your last day, sir? When is your last day in the executive role? Achha, not fixed a date. Not fixed a date, but he said that no, he is. So is it an expression of like he's tired of running a bank? We don't know. We'll ask him all these things. So do they continue to dream big, or they find it that it's a tough time? And to be fair to the industries, this COVID came, and you know their business model, most of them are into the kind of business model they are, hugely affected by COVID. And I'm not getting into any particular entity, but all of them had seen surge in their bad loan portfolio in the past 2 years, but they are coming out. So there are issues on the asset side, the model itself. I mean, can you sustain? Because you are competing with NBFCs in some sense for the assets, and you are competing with banks for the liabilities, and you are subject to very strict compliance. Unlike, of course, NBFCs are also coming up with that. So that's the context. So probably not everybody knew that life would be this kind of difficult. COVID had made it more difficult, but even otherwise also, because you are, as I said, repeating, competing with non-banking finance companies in the asset space. But unlike them, you need to raise liability from the public, for which you need to have capex, like have to branches, spend a lot of money, and also the regulatory requirement, the SLR and CRR and all. As an NBFC, you can raise money from the banks. And if you look at the cost of money there in absolute term, and cost of money loading all this regulatory SLR, CRR and CAPEX, you are definitely paying more than NBFCs. So on the liability sides, it's a difficult. On the asset sides, again, it's a very different kind of thing. So that's the context. I'll not take much of time. I've already taken 4 minutes. We'll end sharp at 6:30, 1 hour, which is 55 minutes plus more there. We'll take a few questions from you. No personal questions, no grievance redressal type questions, just related to policy and industry and macro level. Okay? And first round is all of you will give some sense where we are. Is the COVID pain behind us, and what else? And then we get into some micro issues. Samita, we start from you.
So,
Get the other.
I just wanted to say that all of us, started 5, 6 years ago, And this 5-6 years, we thought it's going to be a marathon because we have to build a bank, etc. But it turned out like a steeplechase, I mean, you're jumping hurdles, you're going through water and all that. Because it's not just the COVID, which was a big crisis for us, but as soon as we started, we had the demonetization, right? So we went through all this, and all of us have survived. So that is, I think, very creditable. During this period, I think we have grown significantly also. If you look, I mean, from an Ujjivan perspective, our book size when we started the bank, it was about 7,000 crores. Today, it's about 21,000 crores. We've gone through a very tough period of, post-COVID losses, etc. But today, we've recovered completely. And this year is a record year in terms of profits. In the last 2 quarters, between the last 2 quarters, we have made net profit about 500 crores. And this year, we are hoping to maintain that, that run rate. I think, whether we are going to be large or not, I'm sure we are going to be large. Because the next 5-10 years, we should be able to sprint, without too much, too many of these hurdles which were to us. So I think you will see a spectacular growth, among the SFBs in the next 5-10 years. And, that's my prediction, actually.
Okay, we'll get into the micro issues later. Bhaskar Babu. You are in the news, I read, I think yesterday or day before, all over the place. You sold your stake or something like that. So it's part of your stake. Yeah.
Yes, it's been pretty challenging. I think when we started, we looked at challenges as technology and liabilities, and demon happened, and suddenly those 2 challenges seem to have disappeared, and new challenge cropped up, assets. And we were kind of doing it, and then we had COVID. So it has been a rough road, to put it, and we are all hoping that it really leads to an expressway. So it was paved with quite a bit of a difficulty. But nevertheless, I think by either realization, connecting the dots now, or probably we reasonably knew but didn't know that it will be this difficult, is that I think banking is certainly a long haul game. It's not a tactical one. If you really, as Samit was mentioning, if you wanted to sprint, probably this was not the place to be. NBFC is far more clearer, tactical, step by step we can do yearly. And when we were starting a bank, people said the cost of compliance will be very high. Actually, we were really, really naive. I said, how can the cost of compliance be high if you do things properly as per regulations? Same as it would have been an NBFC. But now I really understand the cost of compliance is something very different. It's not just wanting to be good, right, and doing the right things. You'll have to comply with so many things. So one of the challenges that we're all kind of learning, and probably it comes at a huge cost in terms of both time and money, is that we'll have to have the same norms like we deal with the public money as a large bank. Cyber securities, database management, and so on. That has really kind of an added cost, which probably many of us, at least certainly I didn't really know this will be this high. And the SFBs did really take the brunt in terms of the COVID impact. At least the balance sheets and P&Ls of SFBs reveal that COVID indeed did the low-income households. Some of the NBFCs or NBFC as a whole has been able to manage it far more flexibly with a lot more agility, which probably as a bank we have multiple other things. So that's a learning. But the way in which I really look at it is that it's certainly a long haul game. We'll have to play it step by step. It's a compounding one. I think the biggest benefit which you have not seen, just that doesn't really make the risk management bad, is that the ability to really tap the last mile in terms of liabilities is a massive advantage which a bank has. When the time comes around for it, and we'll all be looking like probably good wise men.
Look, you hold on. I'll ask you to come at the end because you see the industry from your part, which is very different. You don't run any particular entity. Paul, sir.
Yeah, as Samidha and Bhaskar said, we also started the bank in 2017. It was a challenging journey. Apart from the common challenges of demonetization, COVID, we had another challenge we faced was in our home state of Kerala. We had 2 rounds of flood in 2018 and 2019. At that point, almost 50% of our assets were in Kerala, but we were able to manage that. And then immediately the next year, we started facing this. Apart from all other building up the bank. So 5 years, I can say that we built the bank. So we are ready to grow. Apart from 2 quarters in the second wave of COVID, otherwise we have been profitable all the quarters. And we were when we started the bank, we had only the AUM was only 2,000 crore. So today it is 13,000 crore, and we were completely depending on wholesale funding. So we could build a retail deposit base. That was the biggest challenge. People, media, everyone asked, how will you manage your liability? Because we are new to the deposit mobilization. So we could, 92% of our deposits are retail deposits. So that was, we could prove that we are capable of mobilizing deposits. So today it's 27,000 crore total deposits and assets put together we have. If COVID was not there, we would have definitely crossed 50,000 crore total business. So there was challenges, but we have learned how to manage the challenges. So in ISAF, when we started, 60% of our assets there was geographical concentration. So we have brought down that to 40%. So we were only in 8 states. Now we are in 23 states. So the geographical diversification happened, product diversification happened, team building happened. So the next phase, next 5 years will be not only for ISAF. I believe that the all SFBs will definitely grow because the foundations are built. That's my.
Thanks, Paul. We'll get into the nitty-gritty and the micro issues subsequent round. Vasu, over to you.
So Equitas, when we became a bank in 2016, we had 53% in microfinance and 47% was secured loans. We actually started our journey of diversification from 2011, so it's kind of a long-term journey that we have been going through. And the demon, like everybody else, had impacted us also. And our ROA went down to the lowest level of 0.35% in 2018 March. But when COVID happened in 2020, our microfinance was already down to 25%, and 75 was secured. Even though the impact of COVID was uniformly there on all businesses, still the lowest ROA we went down to was 1.1%. Even though all the customers were impacted by COVID. And the journey from 0.35 to a 2% ROA was a 7-quarter period between 18 and 19 and 20. Now, post-COVID, our journey to a 2% ROA is probably going to be 2-3 quarters, not 7 quarters like before. Basically, kind of giving us some amount of comfort from a diversified book that we have. And so the impact of market dynamics kind of not being as heavy as, otherwise. And when we became just before we became a bank, our cost of funds was 10.5%, and there was no cost of raising the money. I had 2 guys in the company to mobilize money from the banks, and our cost was 10.5%. When we became a bank, my cost of funds was 13.5%, because we were paying 9% interest rate plus SLR CRR cost plus some 3,500 new staff and 350 odd new branches, and I lost count of the IT investment. All put together, from 10.5% interest cost before becoming a bank, after becoming a bank, the cost of money, not interest cost, but cost of money was 13.5%, right? So we were worse than a BB rated NBFC the moment we became a bank. Today, that cost of funds is around 9%, which means that it is equivalent to something like a A-rated NBFC. And we were a A+ rated NBFC before. So effectively, our cost of funds in a 5-year or a 6-year journey of the bank has come to what our cost of funds would have been if we had continued as a A-rated NBFC. Now the question is, over the next 5 years, hopefully our cost of funds, not the interest cost, but the total cost of funds, hopefully should keep trending down. And I think in the next 5 years, it should be better than a AAA rated NBFC and getting closer and closer to the banks. And I think that is a journey that I'm sure all of us, give or take 1 year here or there, will be going through. So effectively, in our experience, what we can conclude is that if you become a bank converting from an NBFC, typically you can look at a 10-year period, after which you can say you are also really a bank, because your cost of funds has to be like any other bank, which means your lending also will reflect more and more of a regular bank. So effectively, I think in our experience, we can say 10-year is a journey that one has to kind of look out for a NBFC converting bank to truly become a comparable bank.
Thanks, Basu. If I'm not mistaken, when you come to the diversification in the asset book, I think probably Equitas has the most diversified asset book, right? Am I correct in saying that? Is that so, all of you? No, the AU is, I'm not comparing because that's a different animal altogether. And when it comes to CASA, Paul, is it your bank has the maximum CASA among the SFBs? No? Again, Vasu only. Anyway, we'll come to all these things later. Alok, over to you. From the heading an SRO, how do you see the SFB space?
Well, I will not talk from the SRO angle, but because I am not a SRO for the SFBs, though they are our associate members and very valued members. They were once primary members. I will talk from the policy side of it because I have been part of the panel on too many panels which touched on SFBs. And the question often asked is, will SFBs make it or like that and like that? So because if you look at the financial sector in India or any sector in India, one thing is very common in India. One, we celebrate success too early, and we start talking about doomsday also too early. Now, in case of SFBs, let me put some figures into perspective. Because average vintage is 6 years. Out of that, I say 4 because 2 went in COVID. So it is approximately 4 years. In 4 years, if you see in the total banking business, the share of that is scheduled commercial banks, RRBs and all that, the share of SFBs is coming close to around 2% in case of deposits as well as in advances. But if you take RRBs, which were all over India, 79, more or less similar mandate which was given as to SFBs, 178 RRBs at once upon a time, now amalgamated into 43, but reach remains the same. Their share in total business is 3%. So in 4 years you are at 2%, in around 30 years you are at 3%, and still being said that you are, you are not being able to succeed and all that. I think that's not fair. We have to give more time to them, as Vasuji was telling. For the lending rates, for the cost of funding, for the SFBs to come nearer to mainstream banks, which is at 6%, 5.5%, will take another 5 to 6 years. But even then, I would say that the asset side challenge for SFBs will continue to remain, because they cannot get into mainstream corporate banking and corporate lending. So you will move up maybe to 10 lakh, 25 lakh, 50 lakh bracket, and much of it, and that is the toughest nut, I would say, in lending piece to crack. Microfinance loans, now settled piece. You can go and give microfinance loans, small piece loans. Larger loans, collateralized loans, easier. Project financing, easier. But this loan size between 2.5 lakh to 15 lakh, that will be tougher. So that challenge will continue to remain with SFBs. But I am hopeful, later on I will come back on that. Because why I am hopeful? Because there is a special niche for the SFBs. And I personally feel that SFBs should not, they can take their individual journeys, but as a outsider, I would only say that they should not start aping the private banks, the mainstream private banks. They have a special niche to play, and that niche potential is very huge. The green shoots of ecosystem building is happening in that, and that space, because in the just the session before in the fireside chat, the CMD of SIDBI was telling that there are around 6 crore MSMEs in India, out of which 95% are the bona fide market clientele of SFBs. And I was reading a BCG report, it says there only of these 6 crore micro enterprises, their unmet credit demand is somewhere around 60 lakh crores. Huge market potential is there. Rails are being built in terms of Udyam number or digital thing. And I think in next 5 to 10 years, you will start seeing results.
Thanks, Alok. Before getting into the next round, just for the audience, I'm sure it's a very literate audience, but still, what are the SFB animals? Just get a sense. During Raghuram Rajan, when he was the governor, two sets of new banks were given license away from the universal bank. One is payment bank and another is small finance banks. Now the payment banks, RBI would not officially accept, but it's a failure because what would a payments bank do which a commercial bank cannot do? So which is why even though 10 banks were giving licenses, not everybody started businesses. Even those who have started businesses, not everybody is continuing with that. Look at the small finance bank, 10 licenses were given in the beginning, out of which 8 of them are MFIs and 4 of them are from that space. One, which is AU Finance, is secured NBFC, and another is local area bank. Am I correct? So that's 10 of them. And subsequently, we saw PMC Bank been taken over by the Centrum Group. It has become a small finance bank, Unnati SFB, and 2 cooperative banks have been converted. Now, we are not getting into sort of vital statistics of all the banks, but not every bank is doing well. I'm not getting into that. The reason being, most of them, as I said, they have come from a space which is unsecured lending and all. So I just want to start with probably Bhaskar Babu, you gave us and all. Is it a time to change the model? I mean, you can't, unsecured lending, this demonetization came, you yourself said, and then COVID, and something else tomorrow will come up, then the state elections, then different kind of elections, then the loan waiver, etc. So you are always, subject to all these external risks. So is it the time for the SFBs, if they really want to make it big, actually to take a close look at the business model and change it?
Absolutely, Tamal. So, Tamal, it's like this. Earlier, as a
Yeah.
MF5, we are kind of used to do a cookie cutter, single product, fast churn, scale, repeatability. I think SFBs today approximately cater to, as Alok gave the figure, of 2% in terms of banking assets, but it's approximately around 7% of the Indian households. Around 3 crore, you take unique customers as 2 crore, of 35 crores, around 7%. So that's a massive, you have reached around 7% of the households. Earlier, it isn't easy to diversify in banking, that you hire the best team, you put and then you give the pricing and you give scale. That's the learning that we all have. So it will take time. You can't really rush in to kind of become the largest secured lender quickly at that. So the transition is happening. Either Ujjivan or Suryodai is currently at 65-35, 65 microfinance, which is actually the profit pool, and then you start building the secured pool. For Vasu, it will be 80% secured, 20% probably unsecured, or 15%. I think probably for ESAF would be the same. So the transition is happening, but it is best that we really kind of settle down, that nothing can get accelerated faster than we can manage. Then you are really building risks in the so-called secured portfolio, which is not really manageable. At least we have the reasonable experience in terms of managing the risks in an unsecured business. The only difference post-COVID, which has happened when we look at all the negatives, is that while 20% of the customers have delayed, defaulted, have become bad, of the overall 6 crore customers, 80% of the customers have paid when there was every possible motivation around, if I can call that way, in terms of not paying. So this time we saw a clear breakout that the customer who wanted to pay ended up paying. 80% good is one way of looking at it, but how to really manage the 20% which really kind of went bad is a challenge. But earlier, all of us, including MFIs or SFB specifically, were looking at customers as account numbers. Past track record is good, 35,000 good, give 50,000, then 75,000. For once, I think the microfinance regulations also really requires that. We have started looking at in terms of what the customer is. What is the household? So the requirements for within the household is no more. Microfinance customer is a customer who's looking forward to you to give a loan and pick it up. They have also graduated. They have a requirement for a two-wheeler loan, a commercial vehicle small loan, a micro lab or a micro home loan, and in some cases a proper home loan. The son gets into a cognizant for a 3 lakh, 4 lakh. The household income has moved from 3 lakhs to 7 lakhs quickly at that. So I think our ability to capture that data, to dig in within our database itself is a pretty customer base, is a very large opportunity. I think all of us have started looking at it, as Salok said, 2 years, it was stray bullets hitting all over. Actually, we are lost in terms of where we are standing. I think we have reasonably, I would say that as a sector, we have got a grip in terms of where we stand. Equally important, it is not going to be all hunky-dory from tomorrow. We are all going to be kind of having 0.5% credit loss. Some of the business we are in is a 2%, 2.5% credit loss business, which does not show up year after year. So if we should now have the character of saying this is a 6% write-off in credit loss business at the end of the third year, fourth year, can we start really providing for it year on year in a year when the things are good, rather than saying that I didn't know it and suddenly once in a 4 year it happens. We have seen an Andhra crisis, and then we have seen demon, and then post that we have seen COVID, and tomorrow, God forbid, it could be something else. But clearly it is a business which is a little high credit cost business, and the only the thing about this is that it doesn't happen year on year. It happens once in 4 years.
Paul? This is the time to, the question was, or the issue is discussing that, to relook at the business model. You can't just depend on this unsecured loan and compete with MFIs and then become vulnerable to externalities.
Yeah, I don't fully agree that we should completely move out of the unsecured business. I don't believe in it. So I wanted to, in ISAF, we have a focus. We wanted to continue to work with the low income segments. So, but we will definitely, we are working on it. Today, when we started, it was 100% unsecured. Today, it is 78%. So, we wanted to, over the next 2-3 years, we will bring down that to 60%. It is all about perception. So, so how do we manage the perception? Recently, I visited, I went to a visit, and later I sent a team to BRAC Bank, Bangladesh. So 57% of BRAC asset is MSME, and it is 90% of the MSME. 90% of the MSME book is unsecured. The average ticket size is 7 lakh. So it is. They have a huge network in the field. There are more than 3,000 people. It's a high touch model. So I think if you really wanted to serve the micro customers. So, for example, we have built almost 6 crore microfinance borrowers. All of us have played an important role in doing that. So, what next for them? So, recently, in last year, we did a study among our customers. So, 25% of our micro loan borrowers create 3 to 5 jobs. They have a business. So, they need a high ticket loan. So they may not have a collateral to give, but the stock, they have the business, the hypothecation of their assets, all these things are possible. So government also have to think, so Alok ji is here, so we can work with the government, whether we can have a separate guarantee fund for such things. So unless we give this, provide loans to these segments. So I am talking about this, it is beyond the MSME, the regular MSME. These people are not the real MSME. They are in the below the so-called MSME, the nano. So I believe in continuing to work with them. So I'm sure we'll be able to manage us. But there is we'll find a way to manage the risk.
Thanks, Paul. So, Alok, now you need to respond, because Paul says that SFBs should remain in this space in the microfinance and unsecured lending, but probably government should give some kind of guaranteed loan, guaranteed money, some kind of guarantee, but which is highly unlikely, because that's one of the reasons why the DFI's model did not survive, because the government pulled the plug. The ICICI and IDBI and IFCI till the 90s, they were getting some kind of concessional fund from the government, and once that tap was switched off, then they got into the asset liability mismatches. So you are a listed entity, you are in the business of doing banking, why would government come and give you? I mean, that would be the argument. So anyway, Alok, because you are representing an organization which is a spokesperson for the industry and SRO, tell me, is it a time to change the business model, or let the business model remain and look for some concession from the government, as Paul suggested?
Well, first, I think if I heard correctly, Paul ji said that we will not exit this business line, but we will reduce the concentration on that. So that's perfectly fine. What business model to pursue, that is particularly left to the institutions. But I always said that my personal view is that based on the market niche which is available, they have to operate within a segment which is not at the corporate level, but what I say, the loans size up to say 40 lakhs, starting from 2.5 lakhs. And these are very tough loans to crack. Now, on your question of guarantee cover, why should government give guarantee? Well, if the government is serious, because even the fireside chat which you were having just before this session with Mr. Raman of SIDBI, he was also talking about that guarantee fund. And if you remember that he spoke that in Japan, Financial Corporation provides the largest amount of guarantees worldwide, even to its MSMEs currently. And he said that you will be surprised, but it is a matter of fact that in all developed economies, MSMEs who are formal, they have been formalized through a process, they have that guarantee cover to grow. Banks are at liberty, they can take some risk in lending to them. That has been the backbone of that economy. In India also, if you want an inclusive growth, and that is what the government says, and if we have to walk the talk, we are not saying that we are the SFBs or anybody who does this missing middle between the microfinance borrowers and bank loans to be completely risk transferred there, but some comfort to the banks in lending to a business where a very detailed appraisal is required, the documentation is missing. If some comfort is given by guarantee, I think it is a thing which is worthwhile for the policy to take up.
Samita?
What we believe is, each of us come with a DNA and where we have competitive strength. And as far as Ujjivan is concerned, our DNA is microfinance and our competitive strength is there. So our base business is going to be microfinance. But we had also, as an NBFC, started our affordable housing, which is a secured business, and MSC this thing. So these are all part of what I would say why SFBs were established, to actually provide services to the aspiring middle class, aspiring businesses, and also affordable housing also falls into that portion. So over time, we expect that 50% of our business will be unsecured, but that will be largely microfinance. And there's a reason for it. Microfinance is probably the most profitable banking business there is. Net interest margin is around 10%. Which business in banking business gives you that kind of yield? It's incredible. And then we are trying to build both the MSC and housing business apart from the liability side. However, post-COVID, business which actually took over very fast, which accelerated very fast, was the microfinance business. It took us more time to build up the affordable housing and MSC businesses. So consequently, that target of achieving that 50% secured, unsecured got slightly pushed back. But over time, that's what we want to acquire. And the other thing I just want to tell you is, you will find that the SFBs offer best interest rates in the market. And that's for a reason.
For the depositors you're talking about.
Depositor side.
Yeah.
Because the yield we get on our microfinance loans, we can afford to pay that interest rate. So that actually gives us a competitive strength. But over time, as we build our MSC business, housing businesses, etc., it will require a different type of funding at a lower cost, etc. So, the liability management will become much more complex. So, as far as we are concerned, yeah, the business mix will change. But our core strength will remain microfinance, which gives us the best yield, and that's where our strength is.
Thank you, Samita. It's a very, very, very straightforward approach. What Shamit Ghosh is saying, that microfinance is where it's a cream of the business is it's a, like, where else do you get this kind of so-called NIM, net interest margin? Your cost of money is 10% and you are charging 21, 22%. So 10 to 12% NIM, where else do you get? Incidentally, what's your, because I'm sure there are many people who are looking to park their money and expecting saving deposit rates to go up further. I'm giving you an opportunity to market, or what's the maximum interest rate you are offering to depositors, Shamita? How much? Sir, use the microphone. How much? How much? You use the microphone, others, sir. How much? Maximum, how much you are offering?
All of us are in the same range.
No, no, what you are offering, not sir.
Percent something, but
8% plus.
but the,
Bhaskar, how much?
8.75, 5 years.
8.75,
8.5.
8.5, 8.75, you.
8%. 8.
So those who are looking to park their money, you can heard that between 8 and 8.75. Anyway, Vasu, you are the last speaker. After that, we'll take a few questions and we'll go back. As you see, I don't have any questions, etc. I have just a menu on my lap. There's no questions. So we're just going by the flow. If you wish to ask any question after this, please raise your hand and get the microphone ready. Vasu, you are already the most diversified business portfolio. Shamit says that he would like to, microfinance is the DNA, he will not bring it down, but 50% is fine. Rest of them said they will bring it down, but still microfinance will be the mainstay kind of thing. But you tell us, give us a sense what it is. But typically what we hear of late that investors are not very excited about the space. They said, no, it's, it's not worth because too much of external risks. We'll make money for 1 or 2 or 3 years, then entire thing will be wiped out for the next 1 or 2 years. Either COVID or flood or elections or loan waiver, etc., demonetization. Over to you.
Yeah, I mean, see, the SFB licenses were given by RBI for the purpose of financial inclusion, right? That's a preamble to the licensing guideline itself, because they believe that we have that last mile connectivity to the borrowers, and so if we become a bank, the borrowers should somewhere benefit because we are a bank. I think that theme continues and should continue because that's the purpose for which this category was created. And so I think that should continue. Question only is how do you balance risk versus inclusion? I mean, inclusion is a great agenda, no doubt. But at the end of the day, if you say that you have really done a great inclusion work, but financially, if your organization is stressed, nobody is going to accept it. Neither government nor the regulator, forget the market, will accept it. So you have to balance between wanting to be inclusive as well as wanting to be safe. And in Equitas, we find a lot of connect between these two. Approximately 15% of our microfinance borrowers are our small business loan customers, where of course they have to give us a security, which they do. But the fact is that even if they are willing to give that security, there's hardly anyone else who is willing to lend to them. More than 95% of our small business loan borrowers are NTC, new to credit borrowers, right? So which means that their asset is excluded. So if I am able to give a loan to them, it's still a good amount of inclusion activity going on there. And we have introduced overdraft product for the small business people, and giving them a combo of term loan plus overdraft within the overall limit, and educating them how to use an overdraft facility. Don't just borrow the whole lot and keep it in your savings account or something like that. How do you manage an overdraft account? How do you get the benefit of the flexibility that an overdraft account offers you as a business guy? Which again we believe is a great inclusion theme. And if they taste the benefit of overdraft, surely at some point in time they will not leave you because NBFCs anyway can't do those kind of products. So I think within the financial inclusion space, we should be inclusive because that's a mandate for which this category was created. And if all of us get on to, bridge infrastructure funding, one large, 10-kilometer bridge between some X to Y place, then what's the point? We don't have to have a separate category like this. So I think this category is important. Inclusion theme is very important. And within that inclusion theme, how do each organization balance the risk versus inclusion? I think that's where the whole thing should be, rather than should we be inclusive or not.
Thanks, Vasu. But each organization also has the dream of making it big, right? It's only the midway. SFB is the starting point. Then at the end of the day, maybe not after 5 years, but after 10 years or 6 years or 7 years, you want to become a universal bank. That's how you got into this space, no? You are not forever for inclusive finance, right?
See, big and inclusion are not mutually exclusive at all. big doesn't mean that you have to be, you have to stop doing microfinancing or small business loans or small commercial vehicle loans and get on to corporate loans only. That I don't think is mutually exclusive at all. Big is only, we are talking more in terms of size, and like Bhaskar Babu and others were talking of, the affordable housing finance demand in the country is around 10 lakh crores. The small business loan financing demand in the country is around 20 lakh crores. Out of this 30 lakh crores, the total supply of all banks and NBFCs put together is less than 5% out of 30 lakh crores. So, yeah, a small finance bank, whether it is called small finance bank at some point or the small finance category drops and you become a bank, is not material. You can be a 1 lakh crore bank, you can be a 3 lakh crore bank comfortably, and yet be very, very strongly positioned in this niche market of inclusive space.
Thanks, Vasu. Yeah, any questions, this gentleman? Yeah, please. Very brief, no comment, just the question. And who are you asking?
Yeah. So my question is related to topic. Can the small finance make it big? The first is do you see your bank 5 year down the line or 10 year down the line? Each of you can have a comment on that. And the second is see, you guys were doing asset finance, right? So asset is not a problem for you. How you going to raise your deposit, and what's your take on deposit in interest rate raising scenario? Thank you.
Okay. Any other question? We'll keep the questions. Yes. Yeah, please. You ask your question. Yeah. No? It was on. You must have. Yeah.
Hello.
Yeah. Just make it.
So you were talking about inclusion and growth together, right? So I'm trying to build a startup in the neo banking space. I wanted to ask, with the similar question, with the follow-up kind of thing, will you be open to neo banking like Surodaya or Equitas has ventured into to grow your liability so that you can expand your operations? And do you see that as a bigger opportunity going forward for small finance bank to grow larger, as the topic says?
Okay. Liability. Yeah. One more, then we'll get back to the thing. Yeah.
Hello. Am I audible?
Yes,
So
please.
I have two questions. Number one, in the PSU banking space, we have seen consolidation by the government. So will we see the same thing in SFBs? Number one. Number two, I had done a decent amount of analysis on SFBs. I think, like Mr. Vasu said, that MFI business is a very good business on the NIM side, but when we come down to EBITDA and ROA, not a lot of money is being made in that kind of business from an investor perspective. Of course, from a financial inclusion thing, MFIs is a very good thing, but to actually churn money for the investors, I think it may or may not be the best thing. So Equitas, in the past 10 years has pivoted from 100% MFI to almost 15 to 20% MFI now. So will we see that also going forward with the other, MFI turned SFBs like Suryodaya, Jana, ESAF, etc.? Thank you.
So no more question, right? So there are a few questions. One question was that 5 years down the line, what's your dream? That we'll keep at the last answer. I mean, we are planning to have that. But other part is this consolidation, liabilities, and MFI, being an MFI into this MFI business, and you're managing your financials, we'll say that. So consolidation part, I think Alok, you should answer, because everyone else is an interested party. They are running their shows. You represent an SRO. Do you see a consolidation in this space? Like, few of them are really weak and they cannot survive.
Well, I don't think, because if I have to objectively see, not as an SRO, but as
Can you be objective, because your SRO run by their membership fees? You can't afford to chatao them, right?
the associate membership, I would not give the numbers, but
Okay.
but out of 12 SFBs, I would say only one has some financial, I would say, credit quality issues, and that is also not because of SFB's own making. It is of the making of the external situation. You call it the government or all that. You know that.
You would like to name it? No.
Everybody knows it, so you know it well. You can name it, if you want it. So out of the 12, and one has got into that trouble. But if you talk about...
That's not a listed entity. Yeah? I think what he meant is just the one entity, but that's not a listed entity.
And that is not the entity's making.
Okay.
Other than that, while the AUM may be small, because typically in India, if you talk to an analyst, you will say a bank must have this much of AUM, otherwise it doesn't look like a bank. I don't agree with that because, and that is where when you were talking about Rajan report, he was looking at the US model of small community banks which look at inclusion. So I don't foresee chances of a consolidation or merger. And in public sector bank, what he is talking about, that has happened due to their losses. That is because of their non-performance, and that is because of hidden balance sheet, because of government's recapitalization support and sovereign assurance. That is not there in case of SFBs.
Okay, that's one. So the next one more question was that it's good for financial, it's good to be in the financial inclusion space, microfinance, but not necessarily good for your own finance, the parameters. That's what you're saying. Samita, you want to, because you are insisting that this is on your DNA and you really earn higher NIM.
I don't agree with this. You know,
Sorry, please, be disagree.
I don't agree with that in the microfinance business, which gives you such a net interest margin. And we've seen the crises which we've faced. It's not from the ordinary course of business, you know. Our repayment rates are probably better than any other banking business there is. But when a demon comes or Andhra crisis comes, which is a government intervention, or something like a COVID, all of us are affected, you know. And our return on assets are very good, you know, I mean, very good when we are running, you know, the business properly. So I don't agree with that. So
that's good. I mean, obviously, I mean, you can choose to disagree. So, gentlemen, you heard the answer.
I mean, in fact, you know, when we were an NBFC and when we were converting to a bank, a lot of our investors in the NBFC say, why are you converting to a bank? You're getting such a good return and, as an NBFC. Vasu smiling.
Okay.
So, you know, I mean, that's the case. I mean, if you run the microfinance business well, kind of return you can get is incredible because it's a very profitable business, you know.
Okay. So the other part is, and if you also look at the numbers, the quick turnaround post-COVID in microfinance, because they are into the business where, you know, the cash flow starts the day one you start opening. Whether you are running a pawn shop or whether you are selling mutton or chicken or you are catching fish and selling everything else is this. The day you reopen your shop, it starts giving the cash flow, and that's why they are able to pay back very quickly. That's the reason. On the liability side, one gentleman asked the question that raising liabilities is really very difficult. In fact, Samita said that somebody asked you that why you want to become from an NBFC, why do you want to become a bank? Yes, probably here's the reason, because if you are running a good NBFC, you can have the best of both worlds. You can have the margin by charging very high rates, what you are admitting, and at the same time you can also get low cost money if you are a good NBFC from the banks, because banks have their priority sector lending target, etc. They're always looking for the right kind of candidates to give money. So then you don't have to go to SLR, CRR, CapEx and everything else. So how difficult is the liability business? Probably Bhaskar, you are itching to answer, it seems like that. You are offering how much you said, 8.5? 8.75.
5-year deposit.
8.75 Bhaskar Babu is offering.
5-year deposit.
Rush. Bole sir.
I think no, I would rather rephrase the whole thing. It is not you have a product orientation for microfinance. The inclusive finance segment is not necessarily now the poorest of poor, having no access to financial services, has no knowledge. 100% of the families are now digital, completely financially digital. So we are still probably trying to run the model the way we used to run it 10 years back. Model is quickly changing. I will probably little disagree with Samita. He's saying that it is not necessarily going to be a high price business continuously. It is going to be a business where it is going to become competitive for well-paying customers. It's going to happen through digital means. But the only thing is that entire SFB sector, if I have to look at the fault line, is that we have looked at depositors as a separate. We looked at the people who are lending to be separate. But there are institutions like even the Grameen Bank where the amount of deposits from the same segment is more than the loans that have been given to them. It's a very, very hard work. It is very expensive. But the day we do it, the risk management will be very different when the next, God forbid, a COVID were to happen. Can the SFBs call up and say that, hey, don't worry, take your time, 3 months, as Vasu said, I will give you a OD limit, utilize it, relax, come back. 18% of the customers on their own have paid. I would guess that we're 90% if ever were to happen. But the fact is that we keep looking at everything as transactional, as product, high earning, then we are running a danger. If we can convert that into a relationship, then I don't have a fear that God forbid anything happens, I don't need to pay for a month. I volunteer and say, don't bother, take your time, 2 months. That will happen. The day that happens, then we're really talking about completely a different relationship orientation, not talking about microfinance as a product, but inclusive finance as a customer segment. That then will go back to what Vasu said. You will be in inclusion and you will be growing. You will probably have the customer stickiness, which probably would say NBFCs cannot have.
Thanks, Bhaskar. Actually, Bhaskar, you hit the nail on the head. I think all SFBs, you are running two banks. One bank is for Bharat, which is for the liabilities, giving money to subji vendors, to everybody else, to poultry runner, those who manages poultry and do jury work and tailor, etc., etc. That's the Bharat part, your bank. And on the other hand, you are running a bank for India, not only India, for Warden Road and Kemp's Corner and others, which is the rich, wealthy people, and the same which HSBC, Citi and HDFC and ICICI caters to. You are offering them more and enticing them to keep money with them. So that's a high net worth individual. Is that correct to say that? You are actually running two banks. And what Bhaskar was saying, it will be nice if you make the first one, the Bharat people, actually to make them into savers, turn them into savers and keep their own money with you. That's the right way to go. Is that you meant?
Wait a bit, we process 12,000 to 15,000 death insurances every year. The sad fact is that beyond this, they don't have any other insurance, not even PMJJY. Probably if they have taken, the person who has taken has not informed their family, and hence the claim is closer to zero. Now imagine a situation where anybody dealing with an SFB automatically has an PMJJY, PMSBY, 2 lakh rupees, God forbid for this, 12,000 families, while the unfortunate thing has happened. I say, thank you ma'am, we have kind of processed, this is 2 lakh in your account. That's superb goodwill. So there is huge opportunity. So we are probably missing out in terms of lend, high rate, kind of borrow at a little higher rate from a two different segment. The day the convergence will happen, and it's not easy, it's expensive, it is difficult. It kind of says that can it happen 2 years afterwards? But I think SFBs all will come around and say that that's the biggest goal pot we are really sitting on. Converge that, I think you see magic happening.
Samita, you wanted to add?
Yeah, I just wanted to add that, it's not just because of our interest rate people keep money with us. We did a recent survey of our customers, find out what attracted them to keep money with us, and it is service. We provide excellent service to these customers, which unfortunately none of the banks today are providing any of that kind of service. The other thing is the younger generation, if you have a good digital, mobile banking, this, that app and all that, and you offer them attractive interest rates, they keep money with you, So these are basically, the service and a good digital platform for the younger generation gets you a lot of deposits.
Thank you, Samita. We have about 7 minutes left because at 6:30 sharp, there's one more session. We need to wrap up. Two important issues I would like to ask you. And one issue is, Alok, only you need to answer, not you can tell us and all. The RBI new norm, which is pretty old now, 7-8 month old norm, from April it came into effect, is this. It's microfinance is no more an entity-based regulation, it's an activity-based. That's what Reserve Bank of India has said. So I don't care whether you are a bank or small finance bank or whoever you are, the rules are same for everybody. So do you think it's a good thing? This will actually create a level playing field and it's an advantage SFBs?
I think it's advantage everybody. I think whether it is SFBs or NBFC MFIs or banks, and advantage client also. At the end of it, if you go to the field, Ujjivan would have lent to it, Arohan would have lent to it, and the client would not be able to say that Ujjivan is a small finance bank, Arohan is an NBFC MFI, Bandhan is a bank, and HDFC Bank is a bank. The client knows these are financial entities which provide loans. So if the regulations have become same, facing the client, I think it is utmost beneficial to the client, utmost beneficial for the responsible growth of the sector. SFBs also, of course, they are part of the important stakeholder. It is good for them also.
Anybody wants to add anything, or it's fine? So one more thing is, again, it's not, I'm not getting into again traditional India and Bharat, but normally what we hear from the SFBs and all, that lending in urban India is far more difficult than lending in rural India. Primary reason in being this you will not be able to track despite all this, our focus on data collection, etc., you would not be able to track your borrowers. People from Bihar, Orissa, the migrant laborers, so on and so forth. They come, they put up shops, or they run auto rickshaws, or they drive Ola, Uber, etc. They give money, and they can just one fine morning disappear, and it's very, very difficult. So it's better to focus on rural India. There you can track them, and that's where the business lies. As far as this microfinance business, you call it, or unsecured loan, you call it, affordable financing, etc. That's a separate story, because that's a collateral backed. So is that the correct approach, that it's urban India is a very different piece, difficult piece than rural India?
No, I mean,
when it comes to lending?
Tamal, as you know, we started as an urban microfinance, and I think Equitas also started as an urban.
Yeah.
It's not a difficult task. First of all, bulk of the urban poor are not migrant labor. That may be 10% of the population. And most of us lend to people who are permanently living in the cities. And one of the things technology has brought us is geotagging of customers, which we learned during this COVID crisis, etc., which is a very effective way of tracking customers, where they live, etc. So, frankly, it doesn't make a difference.
Askar?
It's a little difficult. Certainly in a few cities, metros, if it is Mumbai, if it is Pune.
No, you are agreeing with what Samita says, or
Not necessarily
disagreeing?
agreeing.
Huh?
I'm not necessarily agreeing. So probably the overall thing in Mumbai, if somebody shifts from one lane to 3 lanes away, tracking them is extremely so difficult. So, and it has kind of shown up during the COVID that the urban losses have been far higher than the rural ones. You can still track people, you can keep going back to them and get it. But I'm sure some model will be there to kind of crack it over a period of time. But as of now, the urban microfinance is far difficult and rural per se.
And so it's, in other words, when it comes to liabilities or getting money, urban centers is pretty good. That's what the focus is on. When it comes to giving money, it's rural India. Is that the model?
No, both plays. Even rural has got both potential for liability and opportunity for lending, and vice versa also. We predominantly a rural semi-urban player, but we also operate in metros. We have started operating, and we have not. If there is a proper system, so we can control that. And one area I think we all missed is that we have opened bank account when we started for all our micro customers. Bank SB accounts were open, but so far we couldn't really use that accounts for mobilizing savings from the poor. I think that one part we missed, and we are now started working on it. There are other banks in other countries have proved that. We need some regulatory support to do that. I hope Alok will take it up with the regulator for that. I think the one question we have not answered about the fintech.
Which was?
Just quickly. The partnerships. We are actually at ISAF, we did a fintech conclave last year. We are very much open. But the problem with all fintechs, we have so far, everybody wanted to build their own customer base. So if you are open for a technology service provider, there will be definitely opportunity, and we are open. Thank you.
So we have just about 1 minute left, or 1.5 minutes. So one sentence each. This gentleman asked a question: how do you see yourself 5 years down the line? If Business Standard is holding a function in 2027, December, you are coming here. So what will be, you will be an SFB MD CEO or a Universal Bank MD CEO? Vasu, starting from you. Even though you wished you have expressed your wish to step down, but it's more about your bank. The next 5 years, Is it turning into a universal bank? Yes or no? Anything else? Just one line each. That's the last one. And get yourself ready to give them a big hand, because 6:30 there's another program will start. We need to rush. One more minute left. That's all.
See, this concept of universal bank and big size is not really connected. You can be big and you can still be a small finance bank. So the universal tag, in our view, is more from the liability perspective, because if many people say you are not really a bank because there's something different in your name, so you are really not a bank, and why should I put my money? So I'll go and say, okay, I'll give you more interest rate. So when I can take the tag out of the name, then I'm expecting that on the liability side, someday, I can start reducing my interest rate and still people will have the comfort of putting money on me. Because on the lending side, I don't see any difference that.
Well,
Yeah. So whether I become a
One sentence, yeah.
universal bank or an SFB, we will be remain the largest social bank in this country, catering to micro entrepreneurs, farmers, and the excluded segments. So that will
look.
be.
My wish list 5 years down the line would be SFB is seen as the preeminent player in MSME financing space.
I would like to see ourselves catering to 1.5% of the Indian households, meaningfully impactful, highly respectable institution, make a pretty decent profit. This is what I would really see 5 years from now.
So, the last was is yours.
As we discussed, we serve a much larger market, the aspiring middle class, the affordable housing, MSC, etc. So in 5-10 years, you will see SFBs will compete with any of the big private sector banks. And whether we are a universal bank, that's more a technical requirement of capital requirement. Universal banks have 8% capital adequacy requirement. We have 15. So obviously, we would like to move towards a universal bank. But I feel that in 5-10 years, there will be SFBs which will give HDFCs, ICICI, and all a run for the money in terms of size and profitability.
So extreme confidence, ambition, and optimism. Big hand to that. So all these gentlemen, they said that it's good going. There are, of course, issues, including the name itself, the Sobrico Small Finance Bank, comes on the way of raising liability, because people ask, who is this entity? Where should I keep it? Small finance, not exactly a bank. But that's a disadvantage. Apart from that, there's nothing wrong with the business model. And they're pretty happy the way it's going. Only 1 out of the 10 entities that got first round of license is not in a very good shape, but the rest of them are pretty well. And they are pretty excited about the interventure and the days ahead and what's in a name, and you can call it whatever it is, but the fact is they are ready to give a run for their money to the universal bank, the ICICI and HDFCs. That's what Samita said. I'm not misquoting you, right? So thank you. We could have gone on, but we need to end it. If you have liked it, so give them a big hand. Thank you, sir.